Okay, thank you all for joining us today for this session of the On the Mark Financial Forum and podcast. I'd like to welcome to the proverbial stage my good friend Simon Brady, who is a certified financial planner and much more with Anglia Advisors. Simon, why don't you introduce yourself to the group and let us know who you are and what you do.
Sure. Hi, everyone. First of all, thank you, Mark, for inviting me on. I am a solo practitioner, certified financial planner, and I deal with personal finance issues for individuals. This is not a corporate thing, it's for individuals. I tend to focus on younger individuals, early 20s to mid 40s, and obviously that group encompasses a lot of potential first-time buyers. I deal with all sorts of aspects of their personal finances, obviously including investment, but also stretching out to estate planning, real estate, insurance, college funding, et cetera, et cetera. I'm located in New York, but I work with clients all across the country.
Yeah, and do so well. So I'm really glad to have you on here because I really value your opinion. I know you work with people on planning from all different aspects and people with all different profiles. And the conversation today is specifically going to be about those who are considering buying in cash. And I think we see this often. I know the agents on the call today are going to say, what are you saying? Don't tell people not to buy in cash. And trust me, we are not saying that. It's not that we don't want people to buy in cash. It's that we don't want them to stay in cash. And we'll explain why. We're going to go through some really compelling numbers that will kind of show you guys how to do this. And the idea is, if you're a real estate agent, this is something you can talk to your clients about maybe financing afterwards. There are some nuances with certain property types like co-ops in New York City and things like that that are unique to that market and how to approach that. But I think people will be surprised by the numbers, and we're going to go through some very specific examples, and there's going to be a little, I'll give you a prelude, there's going to be a little mini quiz for everybody that's attending live today to kind of test your knowledge and see if you can stretch your mind to understand how impactful these numbers really are. So, what we see often is cash buyers come into the market. They often, are feeling really empowered by the fact that they're all cash, and they do definitely get more attention on their offers when they're all cash. My clients compete with cash offers all the time. And there's ways that we try to compete with that, but cash is king, let's be honest, right? So, but the question really comes down to when people buy in cash and they don't look to finance afterwards, are they actually hurting themselves financially in the long run? I think you can probably guess the answer that we're going to come up with. But we'll explain how exactly that works. Now, again, for those agents or buyers in New York City, when you have a co-op, it's a little tricky because you have to submit a board package that will usually say you're all cash. The question is, do you disclose that you might want to take out a mortgage afterwards? That's sort of case by case. That is one nuance that we work with clients a lot on and their agents to try to figure out the best approach. But according to the IRS website, if you buy in cash, you have 90 days afterwards to take out a mortgage and still be eligible for the mortgage interest tax deduction. So that's a really important thing to be mindful of as well. But the main things that I want to focus on today are two concepts that I think we can dive into. Simon, I would love for you to give the explanation of what these two things are. But one is opportunity cost, and the other is compounding gains, and talk about what they are and how impactful they can be.
They're very related. So any money that you spend on a property, every dollar you spend on a property in cash is obviously a dollar that cannot be put to use anywhere else in your life, in your portfolio. So that's where the opportunity cost comes from. Now, obviously, any dollar that you do not spend in cash needs to be replaced by a dollar that comes from a mortgage or a lending product. So the question becomes the balance between what is the cost of that lending product versus what is the opportunity cost of the dollar that you gave away to the seller of the property. And that comes down to if you didn't give that dollar to the seller, the assumption is made that you would come maybe and work with someone like myself, or maybe do it yourself. But you would be able to invest that and generate a rate of return on that money that would then we can compare with the cost of the money through the lending product. So that's essentially the exercise that we went through. So the question then becomes, well, what is that rate of return? And obviously it's unknowable to any degree of exactitude. But based on history, we can look at various rates of return that have been historically achieved by investments. Quite how aggressive you want to be on those investments is on a case-by-case basis. But generally speaking, the US stock market has returned round about 10% per year on average over the last 100 years. Now, obviously, there's extreme variability to that. We've had down 40, up 50. It actually very, very rarely is up 10% in any given year. But that is what the average is. But that also assumes a 100% allocation to US equities, which is a very aggressive stance to take. Maybe a 25-year-old saving for retirement can do that. But probably a 40 to 50-year-old person should not be 100% in equities. So this is a very long-winded way of saying that for the calculations that Mark and I worked on, we have assumed a rate of return of something between 6 and 7% per year. I think that's conservative enough. I think, in fact, we've taken, I think, both extremes of that, right, Mark? We've got a 6% number and a 7% number.
Yeah.
So that's really what the input is to the data that we're about to share with you.
Right. And what sort of criteria, when you're working with a client, what sort of criteria do you determine if you want to be more aggressive? I know you mentioned age and whether they're saving for retirement, but what sort of conversations are you having with clients as you're determining what the right mix of investments might be?
It's almost always around, it all revolves around the time horizon, right? If you pick a time horizon of retirement and you're talking to someone who's 28 years old, you have a multi-decade time horizon. In that case, you can afford to take an extremely high risk or high stock allocation over a bond allocation or a fixed income allocation, purely because, if the stock market crashes tomorrow, who cares? You're not touching this money for multiple decades. In fact, if you're adding to it on a consistent basis, you absolutely want to crash tomorrow, so you can start buying some at lower prices, et cetera, et cetera. If you're putting money away for a down payment on a property that you intend to buy in 18 months, then the last thing you want in your life is a stock market crash. So I generally, when I work with people, if the likely time horizon for them to start dipping into this money is 2 years or less, I really don't want any stock exposure whatsoever. You can get 5% high yield savings accounts now. I would absolutely recommend that money goes in there. If we start entering the sort of 2 to 8 year time horizon, then something conservative like a 25, 75, 30, 70 stock fixed income allocation would probably be appropriate. But by the time you're out at 20 years, I think you can be very, very high stock allocation. There has never been a 20-year period in history ever where the stock market has been lower at the end of that period than at the beginning. Right. So although we can't tell the future, the future is all we have to rely. Sorry, the past is all we have to rely on. So that's generally my thinking. It's all about the time horizon.
Yeah, and real estate is the same. Real estate is an investment just like anything else. When people ask me, well, should I buy now? Should I wait? The best time to buy is now or yesterday, right?
Yeah, or
Because the longer
1972.
yeah, and the longer you're in real estate, I mean, ask anybody who bought 20 years ago if they remembered if interest rates are high or low, or if it really even matters anymore, if their property's quadrupled in value. It was worth it no matter what they paid. Even my people from my parents' generation that talk about the 18% rates that were there in the 80s. When I was probably growing up in that house paying 18%, it just doesn't matter. It's a long game. I think real estate is that way, investing is that way, and I appreciate you sharing your insight on that. So we're going to start a little quiz. So everybody who's joining live, you should see this pop up on your screen if everything goes according to plan, and I'll read the questions for those who are watching or listening to the podcast version. But we have 3 questions. You're not going to be graded on this, but first question: is it a wash financially if you take out a mortgage at a 6% interest rate and get a 6% compounding rate of return on investing that money? The options are no, no way, nope, and not even close. So the clue here is that you can't actually get this one wrong because all of them will allude to the fact that the answer is no. Okay, the second question, this will be an interesting one to see if people have a sense of how much this can actually benefit people if they're buying in cash or not buying in cash, but eventually financing. Assuming a 6% mortgage rate and a 7% average rate of return on investing those funds, how much would you lose if you buy in cash compared to financing $500,000 for only 5 years? The options are, I'll round them off, roughly 8,000, 17,000, 38,000, or 55,000. Be interesting to see how many people answer that one correctly. And then the second one is pretty much the same question. How much would you lose if you buy in cash if we now assume $2 million of financing over 30 years? The options there: 224,000, 821,000, 1.9 million, or 10,900,000. I'll give you a hint. D. It's the highest number you see on here, and now I see people answering D, so that's great. I'm glad you're all listening. So we're going to end the poll. That was just for some fun here, but I think it goes to show how impactful those numbers can really be. If you talk about, we oftentimes see that there's more prevalence of cash buyers on the higher end properties. So someone who's financing $2 million, not uncommon for that to be an all cash deal. And if you look at that over time, and it may not be just one transaction, it may be, you bought $1 million home, and then 5-10 years later, you bought $1.5 million home, and it kind of compounds over time. So it may not be the same property that you own for 30 years. But the analysis is the same. If you're not taking out any debt on your property, that means that you've put now $2 million into this home, and you're not using the debt side of your balance sheet to your advantage. Right? Your money is not working for you. The return on equity in a home, guess what? 0. The value of that asset doesn't go up or down based on how much equity you have in it. It'll go up or down regardless of how much debt you have against it. So the idea is to try to put that money to good use and try to make good use of it. So I'll share the results with everybody that's on the call here, just because they might be curious to see. So we took a pretty deep dive into the numbers here. And I want to share my screen to show you guys some of these numbers to see. Now, the assumptions that we made were a 6% mortgage rate, which is pretty much right where things are right now. Keep in mind, we're expecting that they're going to go lower over the next 1 to 2 years. So in the event that that happens, these numbers are going to get even better. But I think it's fair to assume that, you know, we should be a little bit conservative and assume that people stay at a 6% interest rate. That's been, you know, probably above average of what we've seen over the last 20 years, but we've been in an unusually low interest rate environment for a very long period of time. It's not realistic to stay there. But I think we will come under 6. And then we've looked at numbers based on a rate of return on those investments of both 6 and 7%. And one disclaimer I want to give really quickly is that these numbers are raw numbers. They don't factor in tax benefits of the mortgage interest or, you know, paying taxes on gains, doesn't include fees for investing and things like that. But I think there's enough wiggle room in these numbers to be able to, you know, to have some room there, some grace. So I'm going to share my screen. Bear with me just a second. For those of you who can't see the screen, I'll kind of explain some of these numbers. So for those who can see, we have on the left side a 6% rate of return on investments. On the right side, a 7% rate of return, just so you can see the difference. And what we've done here is compared at different loan amounts, what the cost of the mortgage interest is over 5, 10, 15, and 30 years, and compared that to how much investment gain beyond your initial investment of $500,000, $1 million, or $2 million, and how those two compare and how much money you'd be walking away from if you were to buy it cash, let's say for $1 million, and not get that 7% rate of return on a compounding basis. So I'll just pick a couple of examples here. Let's say you do a 6% rate of return. This is similar to the poll question that we had. If you have a 6% mortgage rate and a 6% rate of return compounding, are you at a wash? And clearly these numbers would indicate that's not the case. So let's say, you know, most people stay in their homes, let's just say an average of 10 years. And let's say we're looking at $1 million mortgage. So the mortgage interest paid in this example is $556,000 and change over the course of that 10-year period. Sounds like a lot of money, but the investment gain compounded over time over that same 10-year period is $791,000, which means you're losing in 10 years $234,000 of potential gains by not having your money invested. And this accounts for the fact that you're having to pay mortgage interest on that property in the meantime. So this is a net gain after your mortgage is paid. Let's take a more extreme example. Let's say a $2 million property. Again, still 6% rate of return over the course of 15 years. Maybe it's a larger home that you can stay in longer. So let's say it's a 15-year term that you're looking at. Mortgage interest on a $2 million loan over that 15-year period is just shy of $1.6 million. The gains at the same 6%, which is a conservative rate of return, to almost $2.8 million. So you're walking away from $1.2 million in potential gains just because you didn't take a mortgage. Now, the interesting thing to look at, and Simon, I appreciate you helping me put these numbers together, is if you just get a 1% higher rate of return compounding over time, let's look at that same $2 million scenario. The mortgage interest still assumed at 6%. But the gains you get from going from 6% rate of return to 7% rate of return goes from roughly $2.8 million to $3.5 million. So now you're looking at just shy of a $2 million net gain based on the fact that you took a $2 million mortgage and held it for 15 years. And as you go further out, what happens with the mortgage is that the interest portion of your payment is slowly but surely going down as you get toward the end of your mortgage. It's high at the beginning. You're paying mostly interest. And then as you get further toward what a standard term of a loan is, 30 years, that interest is now far less, and it's predominantly principal that you're paying. So that's why these numbers are skewed. But if you look at the most extreme example, Simon, that we gave here, a $2 million loan over the course of 30 years, it costs you about $2.3 million of interest. Sounds like a lot of money to borrow $2 million, but that's a long period of time. But the potential gain, if you have 7% compounded over time, is 13 million plus. So you're walking away from $11 million by not financing. Those numbers are staggering. And this is exactly why we wanted to have this call today and to kind of walk through some of these numbers, because I don't think people really realize. I think that's why we asked that first poll question about, hey, if you have a 6% rate of return and a 6% mortgage interest rate, isn't that a wash? And the answer is no, it's not even close, right? And that's the beauty of compounding. And so Simon, I'd love to kind of get your thoughts on this, because these numbers are pretty dramatic.
Yeah, they are. And as we were putting them together, it was just more and more amazing the longer we went out, and the higher we went on the interest. So a couple of things to point out. Obviously, when we're looking at the sort of left-hand side of these tables with the lower time periods, 5 years, is the stock market or is your portfolio going to go up by 6 or 7% with any degree of certainty over 5 years? I mean, no one knows, right? In the short term, you could have 3, even 4 very bad years, and yes, it could go down. That's partly why we're not assuming the long-term return on stocks of 10% for a 100% stock portfolio. So yes, there is definitely some delta here between what could happen and what we're saying, what the data that we're showing here. But the longer you go, the further out you go, the more confident you can be that the rates of return will mimic, long-term rates of return. Over 30 years, it is more likely than not that you are looking at something like, if I have a client with a 30-year time horizon, I am investing them either 90% or 100% in equities, in stocks. That portfolio historically has returned 10%. We're looking in this data, we're still, even for the longer dated examples we've given, we're still using what is definitely conservative of 6 or 7%. So that $13 million number comes from 7%. The more likely return on a 30-year investment is going to be closer to 10%. So that number could even be skewed higher. So the compounding is what is behind this. Compounding simply means, if we work on the assumption approximately that money correctly invested doubles every 10 years, sort of just as a rule of thumb, you invest $1 today, in 10 years' time it's worth $2. 10 years later, it's not worth another $1. It's not worth an increase of 2 times what you originally invested. It's worth 2 times what it was worth after 10 years. So $1 invested today is $2 in 10 years, is $4 in 20 years, and is $8 in 30 years, and is $16 in 40 years. So that mathematical effect, earnings on earnings on earnings on earnings going forward, is what causes these sometimes quite extraordinary numbers. And quite frankly, it's why I prefer dealing with 25-year-old clients, where I can have that kind of leeway, rather than the 50 and 60-year-olds who may have quite a lot of money, but we're dealing with much, much shorter time horizons. You can be a much more you can make a client like you a lot better from my perspective when you can show them these kind of numbers, making use of compounding.
Absolutely. Absolutely. Well, I appreciate you helping me put those numbers together. I was, even though I do this for a living, I was even surprised, even though I knew it would be a pretty dramatic number, seeing them and actually seeing them side by side. It really shows you how impactful this could be. And I think, there's some other considerations as well. Obviously, not everyone has the ability to qualify for a mortgage or for the amount of mortgage that they want. It's all relative. So, but a few other things that I think people should understand is also that real estate is an illiquid investment, right? So you can't just go to the cash machine and take money out of your property. So there's something to be said for having funds. Obviously, most people, I would assume, who are buying in cash still have some left over. They're not using every penny that they have, but just having access to cash gives you the opportunity to invest it in some good opportunity that comes up, whether it be real estate or otherwise. We talked earlier about how the return on equity is zero, right? You don't gain value in your property because you have no mortgage. So if you leverage it, not only are you hopefully seeing appreciation over time, but then you're also using the debt side of your balance sheet to create additional wealth. This is how people do it, is using the house's money, so to speak, which is a lender who will give you a loan happily, speaking for myself, against your real estate, to be able to use that money wisely and build a more secure financial future. And the other thing I want to point out is you don't have to be all cash to use this concept. It can be someone who, for example, we see this fairly often, somebody buying, let's say, $1.5 million property, and they want to put down $1.2 million, and they're high earners. They can certainly support a larger mortgage, but they have this sort of, I don't know if it's a Depression era mentality, where they just don't want to have a large mortgage, or sometimes it's a cultural value or whatever it may be, where people are nervous about having debt. They just don't like debt. But this example kind of shows you how using debt in an intelligent way, we're not talking credit card debt at 25%, but mortgage debt that's secure and fixed for a long period of time can be really valuable. So this, for those real estate agents or advisors that are on the call today, this same thing can be applied to someone who's putting a large down payment. It doesn't have to be all cash, all or nothing. The other great thing that I love as a real estate investor, and we talk a lot about this, is that cashing out money against your property is not a taxable event. So if you want to create capital, you can pull equity out of your property and use that money as you wish, and you're not paying taxes on it because it's tied to debt against the property. And lastly, because I love talking about real estate investing, I could talk about it all day long. When you leverage properties as opposed to putting all your eggs in one basket, so to speak, it would allow you to buy multiple properties using leverage as opposed to the same amount of money where you might only be able to buy one. So I think the moral of the story here is put your equity to use. And from the numbers we looked at, you can look at it from this perspective. You're getting paid to have a mortgage. Sounds crazy, right? But you're getting paid. You're earning income because you have a mortgage. So I know some people are out there saying, well, I have a really low interest rate, so I don't want to give up my $200,000 loan on my $2 million property. But when you look at these numbers, you realize even going from 2% to, let's say, 6%, but if you're able to invest that money over time, that might be an advisable solution. Now, we always are very careful not to overstep our bounds and tell people what they should be doing with investing. That's always a partnership we have with a financial advisor like yourself, Simon, or others that I see that are actually on the call today. Hello, everyone. So we definitely don't overstep there and claim to know what people should be doing with their investments. But that's why we partner so closely with the advisor community. But if you look at this from different perspectives, so if you're a client or you're a buyer for yourself, and you want to discuss the scenario, or you need someone who can help you figure out what you can do with that money in the right mix, you can definitely reach out to us about that. If you're a real estate agent, the benefit of this call today, I think, is to be able to have this knowledge and be able to present this to your clients who are thinking about going all cash. And that helps you set yourself apart from other agents who just, every agent loves an all cash deal, because every seller loves an all cash deal. But the question is, do most agents understand what the implications of doing that are if there's no financing afterwards? And if you are, excuse me, if you are the one that is presenting that idea or concept and say, hey, you may want to look into this because I saw this really great podcast with Mark and Simon, and they really showed us how these numbers pencil out. This might be something you want to talk to them about. I think that could be a way for you to deepen your relationship with that client. And if you're an advisor, Simon, you and I partner on this type of stuff all the time to help clients look into what the best solutions are. We can partner with you to try to find the right angle, the right loan, the right scenario for your clients to try to make the most of their equity and put that money to use. So that's all I had today, Simon. Any last thoughts on your end? Anything else you think we missed or need to share with the group?
No, you've covered it very well. Thank you for inviting me on. As I mentioned earlier, I do work with younger-ish clients, and I do have this conversation quite a lot. A lot of people will come up with their all cash stuff by borrowing from family. This is sort of the other aspect of this. They may not have $1 million lying in cash in the bank. They may be going to some form of extreme internally within the family, getting money off parents and all this sort of stuff, just to be able to have the all cash thing. So the situation can even be more extreme behind the scenes, as it were. But no, I think the human brain does not naturally think in terms of compounding. It thinks in a more linear fashion. And that's why this data is so compelling, I think.
It is. Yeah, I've heard compounding interest referred to as the eighth wonder of the world. And we can see how compelling these numbers are today. So, well, Simon, I really appreciate your joining us today and all of your insight and all the numbers we shared. I think our collective eyes popped out of our heads when we saw them. And if we do this every day for a living, and our eyes are popping out, I can only imagine how clients will feel once they realize how impactful this can be. So thank you all for joining us today. And we hope to see you on the next episode of the On the Mark Financial Forum and Podcast. And everyone take care and have a great day. And if you want to reach out, we would be happy to connect with you. You can email my team at mmteam@njlenders.com, and really like to interact with anybody who's interested in learning more. So we will be posting this episode along with Simon's contact information in case anyone wants to reach out to him and get his insight. But thank you all for joining us today. Thank you, Simon, for being my guest today, and look forward to collaborating further.
Thanks, Mark.
All right. Take care, everyone.